Everyone, and thank you for joining us for today's webinar, Valuing Derivatives. My name is Laurel Dobbin. I will be your moderator today, and we're going to start off just going through a few housekeeping items so that you're all set and ready to enjoy today's webinar. You will see your webinar pane in front of you. Please note that the orange arrow will allow you to minimize or maximize the pane. If it's minimized, simply click on the orange arrow to bring it back. Feel free to submit any questions that you may have throughout the webinar. Our presenters will do their best to answer questions at the end of the webinar, and any questions that we don't have time to answer, they will follow up with you after the webinar with an email to answer your question. Also a reminder that all webinar participants will receive a copy of the slide deck as well as a recording of the webinar within 3 business days of today's webinar. For your audio settings, if you are using your telephone to listen in on our webinar, please make sure you select to use telephone. If you are listening through your computer speakers, please select to use mic and speakers. If you select the incorrect setting, it will produce an echo sound. And for those of you who wish to qualify for California CE today, you must do the following. Use a personal computer, no PDAs, and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions, and complete the evaluation survey at the end of the webinar. And now to meet our presenters. Dirk Van Dyke is a Managing Director of Valuations and Consulting at Armanino. His focus is on valuations for technology companies. He has 20 years of experience in the Silicon Valley, an ASA in business valuation, member of the Fair Value Forum, and a Master's of Science in Business Administration. His major practice areas include derivatives and hybrid securities, FASB, ASC 805. And Hong Yu is a Senior Consultant at Armanino. Hong performs evaluation of businesses and their various securities. His background includes an MS in mathematics and an MA in International and Development Economics. He's a certified financial risk manager, a chartered financial analyst candidate, and he specializes in the evaluation of common and preferred stock, derivatives and hybrid securities, and purchase price allocation. And now we'll hear from Dirk on our learning objectives for today's webinar.
Okay, during today's webinar, we're going to cover identifying a derivative, what is a derivative and an embedded derivative. We're going to give some examples of those two. We're going to analyze various option pricing models and then look at the appropriate ones to arrive at fair value based on what you're valuing. So it's no longer just the Black-Scholes model that's used to value derivatives specifically. So this is a somewhat more complex valuation than just the Black-Scholes. Thanks. So today we're covering the definition of derivatives, embedded derivatives, options, option pricing models, real options, which are interesting. We're going to give examples of derivative valuations and then examples of embedded derivative valuations. An embedded derivative is a derivative within another instrument, such as a note or a preferred stock.
Okay, and we're going to jump right into our first polling question. The first question is, other than the employee stock options or options that are publicly traded, have you ever dealt with derivatives? This should be an easy one for everyone to start off with, and I will close the polls in 3, 2, 1.
Okay, so it looks like about half of you have dealt with derivatives other than employee stock options or publicly traded options, and half of you haven't. So it's a nice mixed audience here. We will go on and look at what are derivatives and embedded derivatives. Okay, so you can see the terms of a derivative up there. So what do those mean? Underlying notational amount payment provision. The contract has both of the following items which determine the amount of the settlement or settlements, and in some cases whether or not a settlement is required. So a settlement might be zero, no settlement. One or more underlyings, one or more notational amounts. So underlying, for example, is if you buy an option on stock, then the underlying would be what happens to the change in the stock price, which is not the same as buying the stock itself because of the next item, the initial net investment. The initial net investment could be zero, or in the stock example, publicly traded stocks, say, the initial net investment can be smaller, much smaller than would be required other types of contracts, for example, to buy that stock. So when you buy an option in publicly traded stock, you have the right to buy that stock. And you can make a lot of money if if the stock price goes in the direction you're predicting, or you can lose your entire net investment. But that net investment is smaller than had you bought the stock itself. Lastly, there's a net settlement or payment at the end of the option. So a contract can be settled net by any of these methods. Its terms implicitly or explicitly require or permit net settlement. It can readily be settled net by means outside the contract, or it provides for delivery of an asset that puts the recipient in a position not substantially different from net settlement. Okay?
And there are instances where derivatives can be found inside the contract, as Dirk mentioned earlier. Those contracts are often called hybrid securities, and some security instruments such as bonds, insurance policies, and leases may contain some forms of embedded derivatives. Those are not explicitly stated as derivatives, but together as a bond, they behave as embedded derivatives and hybrid securities. So let's go over some quick examples of derivatives and embedded derivatives. The derivatives are, the things that are commonly mentioned are stock options and stock warrants, which are right to buy stock, and forward contracts as well as futures. You set a price in the future for sale or for a buy, or performance-based options. When a company goes on IPO, and maybe there are options being granted which could be vested depending on the prices. And there are embedded derivatives. These are not, again, derivatives as a contract, but you can see the anti-dilution provision of a preferred stock meets the definition of the derivatives. Also, as redemption rights of a stock or note, the right to sell basically is a derivative. Conversion right of a stock or note also can be a derivative. For example, it's like a preferred stock can be converted into common stock, or a note that can be converted into either preferred or common stock. That's considered also as a derivative. And participation right of a stakeholder. For example, if a Series A investor has a right to participate in a Series B financing, then that also is considered as a derivative. And there are other various customized deals that you will not think it as a derivative, but they actually are. For example, there was a Hollywood actor, like he invested in a company, but he also agreed to do a TV commercial for this company. And in return, he also received, in addition to the note, he received some warrants that had liquidation preference. he had the right to receive a certain sum of amount when a company goes through an exit before everybody else. And that amount that he would receive was dependent on the exit price.
So just briefly, the most common embedded derivative that we see is anti-dilution provision of preferred stock. So typically a preferred stock investor, in order to protect the value of his or her investment, will have an anti-dilution provision in the preferred stock agreement. So they buy Series B preferred stock, say, and if at a later date the anti-dilution provision is in there, at a later date that the company sells stock at a price lower, for example, than what they paid, say they paid $2 a share and then things don't go so well for the company and they have to have a down round at $1 a share later, the anti-dilution provision would give the owner, the investor in the Series B, the $2 a share, the right to get additional shares of stock based on a certain formula that's contained in there. So the instrument itself is a preferred stock investment, but it has the embedded derivative, which is the anti-dilution provision.
Okay, now we're going to go on to polling question number 2. Just a reminder for those of you looking for CE today, you do need to answer 75% of these questions. Our question is, true or false, derivatives can be an asset or a liability? Again, true or false, derivatives can be an asset or liability. You can pick true, false, or not sure. And I'll go ahead and close the polling in 3, 2, 1.
Okay, so the correct answer for this question is true, which most of you got it correct, which is great. So just to give a little wrap up, the derivatives or any contract has two parties that are involved. So the derivative can be an asset or a liability depending on which position you're in, whether you're the buyer or seller, or depending on the option. Or, for example, if it's an option, then whether it's a put option or a call option has impact on whether the derivative is going to be an asset or a liability.
Okay, options and option pricing models. So why do options matter? So the reason why we're giving this presentation is not so that you can go out and invest in options on the stock market. I'd recommend getting further additional education if you care to do that. The reason why we're doing this is that auditors are increasingly requiring their companies they're auditing to get options and derivatives that are on their balance sheet valued and put on the balance sheet at fair value. So an option, as we say here, represents the right but not the obligation to take action given various circumstances. There's a variety of options. Call option is the right to buy. Put option gives one the right to sell, oftentimes it's a stock. A European option gives one the right to buy or sell only at a certain time, typically at the end of the contract. So if it's a 1-year term, only at the end of 1 year, right before it expires, would the holder of a European option have the right to exercise that option. Alternatively, an American option is the right to buy or sell at any time before expiration. This is what employee stock options typically are, American stock options. A binary option, not surprisingly, is where you get either zero or you get some positive dollar amount. And a compound option is an option on an option, which we don't see that often in financial reporting, but could crop up. Okay, so here are the different option pricing models. The one most people are familiar with is the Black-Scholes model. It is, well, simple to use a mathematical formula. If you look at its derivation, it's very complicated, but in terms of practice, it's a basic model. You stick some inputs into a model you can find on the internet or an Excel spreadsheet, and then it pops out the answer. The SEC has stated that the Black-Scholes model does not capture the features in certain options and derivatives. An example of this would be a performance option, which is, say, an option in stock of a publicly traded company that only vests when, say, revenues hit a certain amount, or alternatively, we've seen when the company's stock performance achieves a higher return than a basket of defined portfolio companies within that industry. Or it could be a privately held company where if earnings hit a certain level. So that's what a performance-based option is, and that is not typically valued. It cannot be valued accurately using the Black-Scholes. To do that and to value a number of other options and derivatives, you'd either use the lattice model, which is a discrete time model. If you've seen binomial trees, are also known as decision trees. So you start off with one node, then you have two nodes, and you have four nodes going off to the right, say. You look at what happens under all those. You come out to the values at the end, various different values, and you discount that all back to a present value using a risk-free rate. Or the Monte Carlo method, which is a pretty powerful method that uses a massive number of simulations that model inputs. So we'll go into that in more detail, but it's say 10,000 or more simulations looking at what the output is, the result, based on varying inputs. Thank you.
Okay, and time for polling question number 3. What type of option would you generally purchase if you expect the price of stock to rise? A put option, B, call option, C, binary option, D, American option, or E, not sure. The votes are coming in. I'll give you a few more seconds. All right, I'll close the polls in 3, 2, 1.
Okay, so here are the results. So we have a little bit of a mixed bag here. Like 40% of people said put option, and more than half said call option. Actually, the correct answer is call option. The reason for that is call option predetermines the price that you can buy. So if you're expecting the stock price to rise, and if the call option allows you to buy at a price that's lower than the expected price, then you would use the call option to buy. Put option is a right to sell, and it's something you would use when you expect the stock prices to go lower.
So employee stock options, which are used extensively in Silicon Valley, in technology, life sciences, and other types of firms, are call options. And the theory being that employee starts when the company is young, its value is pretty low, it gets a right to buy in the value at that time, and then over time its value increases, and everyone hopes that their company will be the next Google or Facebook, and that they'll receive a lot of money from their employee stock options.
Okay, so let's talk about real options in the derivative valuation. So real options are options probably that you never thought that they were options. It's some things you consider as you run your operations, some certain business initiatives, or such as whether you want to expand a project or abandon a project, or you want to focus your operation to certain product, something like that. All those decisions are simply called real options in theory. And often when we value the derivatives, how you consider your operation as well as what's expected of your operation matters a lot. For example, when we consider valuing a derivative of, then we would ask you several questions like what's the probability of financing, what's the time to next financing, or probability of loan default if it's regarding a note, or probability of your exit. These things are something that you cannot really give a definite answer, but you could have an assumption like within a range. And all these factors could matter in the derivative valuations. And especially these are very useful information when we value embedded derivatives as well.
Okay, so now we're going to go over some examples of derivatives and embedded derivatives. Okay, one example is an exchange-traded option that probably most people are familiar with. You can go buy one right now, and you think the stock price of Facebook is too high, or the price of another company is low and it's going to increase in value. You can go out and buy one. As Hong mentioned, if you think the price is going to go up, you'd buy a call option. So theoretically, the Black-Scholes model wouldn't be the best model to value an exchange-traded option. The preferred valuation methods are theoretically correct. If you were in an option valuation class, for example, would be either the lattice model, constructing a binomial tree, where if at the end nodes the options are in the money, you would exercise, get the net amount, your call option price, exercise price, minus the price of the stock at the end, discount that back to a present value for all the nodes at the risk-free rate, come up with the value, or the Monte Carlo method. So that's, as I mentioned before, where you have, say, 10,000 simulations that result in an output. In this case, the output being the price of the stock, and the option would be exercised whenever the option's in the money. So the reason why the Black-Scholes model is theoretically not the greatest method is because these exchange-traded options include the right to exercise the option at any time prior to the expiration date. While the Black-Scholes model is used in practice often to value these exchange-traded options, theoretically it's definitely not the best method to value one with.
So let's look at an option. As mentioned, exchange-traded options are American options that an option holder has right to exercise that option whenever he wants. So let's consider an American option with the following variables. Let's assume that a stock price is $55 and exercise price of that option is $50 with a volatility of 40% and risk-free rate of 5%, and time to expiration is 1 year. So to keep things simple, let's assume that the binomial tree that we're going to construct has a node time of half a year. So since the time to expiration is 1 year, we're going to create two nodes for every half a year. And based on a financial model, you can predict the ranges of the stock prices in 1 year. So based on the model, you can get that in a year, the stock price would go as high as $96 when it's $55 today, or it could remain at $55, or it could go as low as $31. Then we can calculate the benefit of an option holder if he exercises the option. At $96, the return on the of the option holder is $46. At $55, the return on the holder is $5. And at $31, the return on that is 0. And we calculate the value of these returns in 6 months. So in the yellow cell, typically, if it's an European option, it would be probably weighted return of the nodes in the 1 year time. But since this is an American option, we would compare that probably weighted value with the return of the option holder if he exercised the option today at $72. In this case, it's more beneficial for the option holder to hold on to it and exercise the option at the 1 year time. So the yellow cell indicates the max of is equal. The value in the yellow cell is equal to the probably weighted return at the 1 year node time. And this, we can do the same if in the node time 6 months, assuming the stock price would go down, and the value in the blue cell indicates the probably weighted return of the option at the 6 month time.
Okay, participation right. So say I'm an investor, I invest in the Series A preferred stock, and one of the rights the preferred stock agreement gives is the right to participate in the Series B preferred stock financing. So you're the CFO of the company, and you're doing in the midst of your audit, the auditor comes and talks to you and says, well, you know, based on recent SEC rulings and what the FASB moving towards fair value, we're now required to have this right to participate included as an option, include the fair value of that option on your balance sheet. So you look at that and you go, okay, well, I'm going to use the Black-Scholes model. I'll just, you know, I'm familiar with that. And unfortunately, the Black-Scholes model is not applicable in this case, primarily because there's too many uncertainties, there's too many variables to value just using the relatively simple to apply Black-Scholes model. The uncertainties that would be used as inputs in the preferred method, the Monte Carlo simulation method, would be used to model the value would be the time until the Series B financing. You could have the time be, these wouldn't be point estimates now. These would be, say, you might have the most likely time be 2 years, and then have the earliest be 1.5 years, and the latest time be 3 years. The Series B issue price, you could also set the most likely price, the lowest possible price, the highest possible price. The amount, you would do the same thing. You would also, I don't want to go into too much detail, but you would also have to specify a type of distribution for those variables, since you're looking at not a point estimate. Oftentimes the triangular distribution or normal or the normal distribution is used. The triangular distribution would be, say, for the time until the Series B financing, you'd have the highest probability at the most likely time at 2 years. The two lowest probabilities would be at the shortest period of financing, 1.5 years, the longest, 3.0 years, and then the shape of the distribution would simply be a triangle, with the two from 1.5 years to 3 years being the base, and then 2 years being the peak of the triangle. So go up and then back down. So once again, just the main thing here is that participation rights, like a lot of options, are too complex to value using the Black-Scholes. Instead, the preferred method is to use the Monte Carlo simulation method. This is a perfect example of when a 10,000 simulation plus simulation model with varying inputs is what's needed to properly value the instrument. And the uncertainties can be captured using inputs that vary in different simulations.
So We had to value participation right of a company. Let's call that company XYZ. And they had 2 Series A round investors, which purchased 50% of the Series A preferred shares each. And this is how the Series A round looked like. The Series A issue price was at $2, and based on that, pre-Series B shares outstanding, number of shares outstanding were 3 million shares. And each investor, again, had the right to participate in the Series B round. So we're going to assume a few things here. We're going to assume that the equity value is log normally distributed. What it means is that the equity value is more likely to decrease than go higher over time, which makes sense if you consider every business out there. Of course, hopefully that's not one of the case for you. And we had to address a lot of uncertainties that Dirk mentioned, and we discussed with management or the board members, because since they are involved in the fundraising and they are aware of the business milestones, they are the best people to talk to. So we asked some of these questions, such as how much are you planning to raise in the Series B financing? And they said 5 to 10 million. And we asked what's the target number, and they said 7.5 million. So we assumed the triangular distribution with the minimum at 5 million, maximum at 10 million, and the likeliest number at 7.5 million. So there's a little triangle there with 7.5 million as the index in the peak of the triangle. And the next question we asked was, what's the probability of Series B financing happening? If the company was going really well after Series A, they might needed one, or they might needed Series B because the company was underperforming than expected. And based on the discussion, they said there's a 60 to 80% that the Series B financing would close, with the 70% at the likeliest probability. And this one, they were thinking that triangular distribution might make much sense here as well, because the 2 investors were willing to participate in Series B as much as they did in Series A. And another thing we asked was, what's the timeline, of the Series B financing? They said it's going to be within 6 months to a year. But they did mention that it's the likelihood is probably in 9 months, but they weren't very particular about it. And so we assumed a uniform distribution, which indicates that within half a year to a year, any point of time, the probability of Series B financing was about the same. And the next question we asked was, how much equity are you going to allocate to the new Series B round if it closes? And it was something the founders are very, sensitive about, but they did mention that it's going to be 20 to 40% of the company after Series A, and the most likelihood for the equity allocation would be 40%. So we assume the triangular distribution here again. Most of these assumptions that we make with the discussion with management or the board members are simplifying our valuation methods a lot. So without these discussions, the model gets a lot more complicated, and creating a model and defending a model takes a lot of time. But if we spend 30 minutes to an hour with the discussion with management and address these issues, then our model can become a lot more simpler, and it will be easier for the management to understand what we did, and it'll be easier for the auditors as well.
And speaking of auditors, it's best when doing these and other complex valuations, such as a purchase price allocation, to have conversations early on with management, the valuation team, and the auditors to make sure everyone's on the same page, and, for example, to see if the auditors agree with the assumptions, including the type of distribution and the inputs. So if there's one key thing I would take away from this webinar is that it's good to get the auditors involved early. Typically, companies are getting these derivatives valued because their auditors are saying this needs to be done now per the new FASB gap. So it's good to get them on board and have them approve what's going on relatively early.
Okay, so we would typically run a Monte Carlo simulation on all those assumptions together to see how they interact. And this was the result of the Monte Carlo simulation. So based on the simulation, the average or the mean of the Series A investment was not too far from the likeliest investment amount the board expected at 7.5 million. And similarly, the probability of Series B financing was at 70% based on the simulation, and time to Series B financing was at 0.75 years or 9 months, and equity interest, which was that was expected to be allocated for Series B, that had a minimum of 20%, maximum of 40%, but based on the simulation, the average of that was 33%. And based on all those information, we solved for the expected pre-Series B value of the company as well, which turned out to be 3 million, which was not too far from what the management had in plan.
So if I could interject for a second, for those of you who are wondering or notice that Hong has a bachelor's degree in mathematics and we're wondering how someone like that would end up doing business valuations, I think this example here might give some weight to the importance of someone with a strong mathematical background doing derivative valuations specifically.
Yes, it's good and bad thing when somebody in the conference call says, "Hey, you're the math guy." So, one thing I like to mention is that typically in the Monte Carlo simulation, mean or average of a certain variable has more meaning than median. It's because it's a controlled environment, so you would assume that there will be outliers. So mean is typically used in the analysis of the Monte Carlo simulation. So based on those simulation results, we also run another simulation as well. Because we had this Monte Carlo simulation on the uncertainties, we have now the benefit of we can now use the Black-Scholes option pricing model, which was thought to be somewhat incorrect. But using all those inputs in each simulation, we are trying to find the result of Black-Scholes option pricing model and form a distribution there as well. So based on the earlier Monte Carlo simulation and the pre-Series B value of the company, what the most likely Series B investment amount, as well as the equity allocation, we find that expected Series B preferred shares would be 1.5 million shares. And based on that, expected Series B issue price is around 5 million. So we use Black-Scholes option pricing model based on each data point. And this is just one sample data point right here, that if the stock price of Series A was at $2 and the Series B issue price is expected to be at $5, then the call option price in this instance is about 3 cents. And since we are assuming that one Series A investor of 50% would also have right to participate in 50% of Series B financing, we would multiply that 3 cents to half of the expected Series B shares and arrive at the participation right of a Series A investor to Series B round would be around $19,000.
Preferred stock warrant is the right to purchase one share of preferred stock. The preferred method is the Monte Carlo simulation. Why not the Black-Scholes? Again, rather obviously, preferred stock and common stock are different because of liquidation preferences of the preferred, conversion rights, the anti-dilution provision we mentioned earlier. How are they valued? These are typically valued using a Monte Carlo simulation on the inputs of the option pricing method. So those inputs being the term, the strike price, volatility, and exercise price, and the risk-free rate, of course. Another example of an embedded derivative is a redemption right. So someone invests in a company via a note, they loan the company money, and it's a risky venture-backed company, so they want more than just interest. They want the right to redeem the note at 125% of the outstanding principal amount, plus any accrued interest at any time up to 5 years from the issuance date. So obviously, if your company, your standard operating company, and you have a strong EBIT, good profit margins, you wouldn't be interested in this note. But if you're a venture-backed company and you really need money, and you don't want to issue any more equity and dilute your common stock interest, you might do this. You might issue a note, a redeemable note. Okay. So why not the Black-Scholes model here? One, you have the amortization of the loan, and it has to be modeled in. Once again, this can be exercised at any time before the expiration date. Again, the Black-Scholes model only allows for options at the end of the period. So it's a Monte Carlo simulation, but it can be simplified depending on the details of the terms of the note and the redemption right. Simplification can happen when management gives concrete probabilities of default / redemption events and times for these. So this is another case where you can have a simplified, well, relatively simplified model, less complicated than it could be, but it's good to get the auditors and management on board with the assumptions prior to running the model.
Again, one of the most common embedded derivatives is the anti-dilution provision of preferred stocks. That's one of the common things we deal with here. So just consider an example to see what anti-dilution is, the provision is, and how it's valued. So let's say Series A preferred shares of XYZ has an anti-dilution provision, and Series A preferred shareholders invested like $10 million into the company, where 9.9 million of that was in notes and 100,000 of that was into equity. So it was one of the interesting deals that we've seen. And Series A preferred shares are issued at a cent per share, and Series A preferred shares, however, had a conversion price of $1, and that would be adjusted based on the anti-dilution provision if the company issues a common share at a price of $1 per share or lower than $1 per share. So although the equity investment was only 100,000 and equity, the Series A issue price was a cent, this investment is considered as a $10 million investment with conversion price of $1 per share. To value of this anti-dilution provision, you get the X there. So it's because it's a little tricky because it's not actually an option. If you can remember when Dirk discussed the definition of options, it's a right to take an action, but there's no action required to be done if you are Series A preferred shareholder. Because if a financing occurs which issues the common shares at a price lower than $1, then there's no action being taken as a Series A preferred shareholder. So it's not an option. Then obviously Black-Scholes option pricing model is not applicable in this case. And the preferred method of this anti-dilution provision is often one of our favorites here, again, the Monte Carlo simulation, because still there are so much uncertainties regarding the next equity financing that you have to take into consideration. And unless the management or the board member has really concrete probabilities or assumptions and understanding of what it's going to be, then Monte Carlo simulation will be the preferred method of everyone.
And when Hong says this is not an option, he means that if the company issues common stock at a price less than $1 a share, then they automatically have to issue to the preferred shareholders the additional shares that per the terms of the anti-dilution provision. So the preferred shareholder does nothing and receives the additional shares. So that's why it's not an option.
Okay, time for our last polling question. All else being equal, the value of an American option is less than the value of a European option. True, false, or not sure? Those of you looking for CE credit, please remember to make sure you answer 75% of the questions. All right, we'll go ahead and close the polls in 3, 2, 1.
Okay, so the correct answer is false, because American option, all else being equal, typically has more value than European company. The reason for that is, American option gives you right to exercise that option at any time before the expiration, whereas European option, you typically can only exercise at the expiration date. Then this is an added value to if you're an American option holder, if everything is the same as the European option. Okay, so we go quickly about this story. I thought this story was very interesting because it's one of the cases that I can probably never forget. So let's call this Hollywood star Jed Knight. Obviously, I prepared this presentation on May 4th. So he invested in XYZ, and Series Z warrants were issued to Jed, and he agreed to do TV commercials for XYZ. And in addition to that, Series Z had various rights, redemption rights at 300,000. It means Jed could sell it at 300,000 at any time, or he would receive some liquidation preference if XYZ goes through an exit. And that liquidation preference amount was very dependent on the exit price, such as, if it's transacted between 100 million to 200 million, he would receive between 0 to 2 million. If he was transacted 200 million, then he would, but lower than 300 million, he would receive 2 to 3 million before everyone else. And if XYZ was worth more than 300 million, then it should be Jed actually would receive 3 million. So for redemption rights, it was something that we already discussed. So we would apply Monte Carlo method since he had the right to sell it at any time. It was an American put option. And for liquidation preference, what we did was I tried to model the liquidation preference of JED based on the transaction price and constructed a hypothetical portfolio of various securities that I only thought would be useful in schools. It was one of the first times that I had to use something I learned from school that was in my senior year, I think. So this is how the portfolio looked like. It was a mix of different call options. One of them was a binary option that he would receive $2 million. So what basically happened was I used at least group of 2 options to simulate the liquidation preference in the first scenario when the company was between 100 200 million, and negated whatever those 2 options would be worth using a third option, an option C, and used option D and E to model what JED would be getting if the company was between 200 and 300 million.
Okay, in conclusion, we've covered the following topics in this webinar. One is how to identify a derivative and an embedded derivative. We gave various examples of derivatives and embedded derivatives. We've mentioned a number of shortfalls of the Black-Scholes model, which is still used for certain cases, but in other cases it's not appropriate. And we've discussed the appropriate valuation models for certain derivatives.
Okay, and we have some time for questions. We've had a few submitted during the webinar. The first question, and you guys can figure out who wants to take this one, is a warrant attached to a share of preferred stock an embedded derivative?
No, it's actually a straight derivative.
Okay, that was a simple one. Should an American option ever be exercised before its exercise date?
That's a little tricky one because, but typically, if it's an American call option, it would make sense to wait until the expiration date. But if it's an American put option, because the risk-free reward that's assumed in the Black-Scholes option pricing model or any option pricing model in matter is that the value of the company is likely go down than not in the future. So American put option, you would probably exercise before the expiration.
Okay, thank you.
I would also add that could depend on one's personal circumstances and preferences as well. If your call option hits a certain value, that makes a big difference for you. So if you have a call option that enables you to buy a house in Silicon Valley or wherever you live, then you may wish to issue it then. But that's a personal preference and not a necessarily utility maximizing preference.
Okay. Next question. What are the transition or adoption rules for auditing participation rights?
I would have to consult with someone in our audit department for that, but I think it would depend on you could always ask your auditor about that, and I think it also depends on the stage of the company. We've seen the most clients that have had derivative valuations, or the more complex ones, are companies that are nearing a liquidity event such as an IPO.
Okay, thank you. Next question. Why is the Black-Scholes model the most reliable model for valuing European options?
Well, one thing before I would like to mention is a European option is actually not that common in the real world. In the real world, most of the options are American options. So American options was too complicated, to value or to come up a model on it. So mathematicians basically came up with a simplified version of American option, which was a European option, and construct the model there. So in a way, they did two things at the same time. They constructed the European option theoretically, also a valuation of European option at the same time.
Okay, we have a couple more questions, and just to remind our audience, if anybody thinks of anything, you're welcome to type in a question. We have a few more minutes to answer those. Next question, can you use the Black-Scholes model for valuing American options or any other type of option?
The simple answer is no, because that's what we've been discussing. But if you can run Monte Carlo simulations on numerous calculations of Black-Scholes model, then that's one way certainly that we can use that.
I would add that theoretically that's certainly the correct answer, but in practice, for example, when calculating the value of employee stock options for ASC 718, what used to be 123R, that the Black-Scholes model is used to calculate that compensation expense. So it depends on the practice. So theoretically, it's not the best method, but it is used to value, say, employee stock options for compensation expense purposes for the amount that goes on your income statement.
And let me add to that, actually, because as discussed, employee stock options are generally call options. And if it's a call option, American options are typically expected to behave just like European option, where the option holder is expected to exercise the option at the end of period. So the value of those two in those instances the differences would be nominal.
Okay, looks like one final question. What is the strategy behind combining put and call options?
Well, I guess somebody's trading options here, but the benefit of using options is that your cost of buying a portfolio of stocks or funds would be minimized, and if you combine a very nice portfolio of call and put options with your different positions as long or short, then you could make a return with a smaller amount of investment upfront. That was the thing.
And again, I want to stress that we're not investment advisors. We're doing this for just to discuss the valuation of these derivatives and options for financial reporting purposes.
Great. Well, thank you all for joining us today. Thank you to our presenters, Dirk and Hong. On the screen, you'll see their contact information. Please feel free to reach out to them should you have any further questions about today's webinar. We appreciate your participation today and remind you, as you exit our webinar, please take a few moments to fill out our brief evaluation. Your feedback is very important to us. And thank you both for your time today, and we look forward to having all of you join us on a future Armanino webinar. Thank you.
And if you have any questions you didn't feel like answering, or any questions that come up after the webinar ends, feel free to email or call Hong or myself, and we'll be happy to get back to you.
Great. Thank you.